Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. I've often mentioned how the bright green highlighted August 22 to date uptrend, currently at 1914, how it did not act so much as a support or a resistance, but more as a nuisance. Well, 6 weeks ago, this broken bright green uptrend, along with a darker green highlighted short medium moving average, currently at 1896, managed to erode the bullish incentive enough that they allowed another pattern, now since retired, the late February to early July bearish Andrews pitchfork. Well, allowed that pattern to cap the market. And this also happened 5 weeks ago to a lesser extent, and again 4 weeks ago as well, enough that I had drawn a small bearish downtrend, currently at 1743, to show the recent bearish angle of attack generated by that Andrews pitchfork. 3 weeks ago I opined that we might be undergoing a change of heart when I said, in talking about the markets, and I quote, "I do note that this has now dropped down under the previously mentioned broken bright green uptrend and green short medium moving average, and thus has been liable to upward pressure. However, for the moment we are still exhibiting lower highs, a keen bearish sign, but the lower lows have sort of petered out, and we seem to have some support at or just under the 21st century absolute Fibonacci line at 1809. This support has been tested on and off since mid-May, and the room for maneuver is now so tight that either the support will have to break or the upper tine." And that's the end of the quote. Well, we know the upper tine is broken. We've since had a changing gapping move higher 2 weeks ago over the green short medium moving average, as well as now the mauve medium moving average, currently at 1870, and the bright green uptrend. The rise has been as far as just short of the March 2023 low at 2004, where we've seen a rejection there late 2 weeks ago, which, to be honest, looked like long liquidation ahead of the long weekend in the US, but which since has seen a small resurgence in the bearish incentive, though so far not excessive, though today could be different. Now, I did put out there some 6 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern was and is not complete. I've stated over recent weeks that we would need to see how the action develops over the next few weeks, and I still stay by this point. I was very clear on the wording on this point 6 weeks ago when I said, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. Now, this does not take away from the far smaller August-based double bottom which saw its topside fulfilled during late August and early September. Ice Europe white sugar in London. Many weeks ago I drew a start of April to start of July bearish Andrews pitchfork, which I have since, last week indeed, finessed to the current green highlighted bearish shift pitchfork you see on my daily chart, hoping, with justification I believe, that this bearish pitchfork might provide the recent bearish angle of attack. When looking at the action over the recent months, I wish to emphasize once again the monthly key reversal down in July, which has seen some activity in the downward direction until about 3 weeks ago. However, it has been limited. So back to the bearish shift pitchfork, and I noted some 4 weeks ago a new pattern within a pattern, like a Russian doll. This new pattern was the bright red bear channel, you can see highlighted on my daily chart. At the turn of 3 weeks into 2 weeks ago, prices punched up through the top of this bear channel, giving some opportunities on the top side. Primary target X will be in the 560.90 area, with secondary target X1 up in the 599 even area. The high 2 weeks ago of 559.30 came awfully close enough to register as having reached target X, but I chose last week to still leave it on my daily chart for definition. Well, since then, prices have turned lower, pushed down by the combination of the March 2012 high of 548.70, the green upper tine, currently at 547.60, the mauve medium moving average, currently 548.40, and even the green short medium moving average, currently 541.10. Prices are low enough now that I'm considering retiring both target X and target X1. Plus, we may see the market try and fill in the changeover gap, 526 even to 533 even. If the market does try and do that, Then look below at the congestion 506.40 to 517.80, dating from early 2017 to last month, containing the October 2022 low of 514.5 and a September 22 low of 517.80. All this before we even start looking at the green middle time below, and that's currently at 495.30. Sugar white premium spread. I'd previously spoken here some while ago now, but at length about a big picture item seen here on my weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the lower time currently at 149.25, tested, breached, and now broken on the downside. 21 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to the London sugar month changeovers, but it nevertheless set in motion a lower market, though prices took their own sweet time in getting down below the lower time. So, we are now, again, testing the lows of early to mid-October last year, down in the 115.75 to 116 even zone. Indeed, where we have been the last 6 weeks. This is the next support zone, though when prices were down here back in October last year, they were at the same time above, just above the dark blue lower time, which we are not today. Hence, though we have been held up here for a while, this support may not be as strong as seen back then, but I'll give it some time and see. Overhead, we have the 250% Fibonacci lines of the July 2019 to September 22 move at 131.25 and the August 21 to September 22 move at 128.75. Looking below, there are lesser Fibonacci levels further down at 107.75 and 104.5, but I'm not sure how good these are. The next support of note would be the lows of the first week of February 2023 at 83 even. Then the mid-February low, 83.75, just above it, and the early February low at 81.75, which is in between, well, just actually lower down. The only other feature to consider is the new one I have drawn on my monthly chart, which is not as yet, on my weekly chart, sorry, which is not as yet established, but which deserves consideration. It is the April to date descending wedge pattern, and it's currently 94.5 to 132.5. This is still a nascent pattern, descending, but one worth watching, a nascent pattern, but one worth watching. We're right now approximately midway between the upper and lower trend lines of this pattern.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.